Hi, welcome to our webinar, Renewable Energy Tax Incentives and Structuring, which is part of Fasken's quarterly perspectives on tax law series. While I introduce myself on the topic, please see the information slide that is going to be on your screen. Just some helpful hints for keeping the presentation going smoothly. So my name is Rabinovitch, and I'm the co-leader of Fasken's Montreal Tax Group. I deal with all aspects of tax law with a particular focus on tax planning, and in tax planning, more particularly international tax, energy, and financial services. Now, on to the presentation. I'll begin with a brief introduction of what we're going to cover today. The first topic will be accelerated depreciation, which plays a big role in the renewable energy sphere. The second is the use of project assets to generate losses, what we often refer to as principal business corporation or PBC status, Canadian renewable and conservation expenses or CRCE. We've got some questions about that in the lead up to the presentation. And from a structuring standpoint, we'll review some of the main types of structures, corporate versus flow through, and then we'll delve into actually some variations of those corporate structures, partnership structures, and joint venture structures. So without further ado, we'll begin with accelerated depreciation. And accelerated depreciation is really just depreciation for tax purposes of renewable energy assets at a very, very high rate, that it's much higher than the rate that reflects how quickly they depreciate in value in real life. And it's designed, obviously, as an incentive measure. The government allows people to depreciate the assets fast to create tax losses, to encourage industry to invest in clean energy assets. And all of those assets are basically grouped together in class 43.2 of the income tax regulations that sets out the classes of depreciable property. The ordinary rule is that class 43.2 assets, the renewable energy assets, can be depreciated at a rate of 50%, and that's extremely high. It's the second highest, essentially, that is available. And the eligible assets are mostly what you would think of as renewable energy assets: wind turbines, solar panels, control, conditioning, and battery storage equipment, support structures, houses, transmission equipment, and things of that nature. And then there are certain assets that are not particularly necessarily, I should say, geared towards renewable energy that might be used in a renewable energy project, like roads, for example. So it's not everything is eligible, but anything that's specialized for the production of renewable electricity, be it wind or solar, for example, is typically a class 43.2 asset. Another thing to bear in mind is what we refer to as the available for use test. And that's going to come up a little bit in the next few minutes. Essentially, the tax depreciation regime the rule states that you can only start depreciating a renewable energy asset, or any asset for that matter, that's depreciable when the asset is available for use. And that's defined in a somewhat complicated way in the Income Tax Act, but in a nutshell, it's when it's ready to be used for the purpose of earning income, when you can flick the switch and start producing energy that can be sold. The last concept that's relevant here is what we call often in tax the half-year rule, which says that in the first year that you acquire a depreciable asset, you can only depreciate half of what you otherwise would be entitled to. So in the case of a class 43.2 property, that's typically depreciable at 50%, meaning you can depreciate 50% of the cost of the property in the first year, in every year, essentially. That's decreased to 25% in the first year under the half-year rule. And then whatever's left of the cost that you didn't depreciate in the first year, the following year, you can depreciate 50% of that, and so on and so forth. So that's sort of the general regime. But we're going to see in a second that general regime has actually changed slightly in the last couple of years in a really favorable way, temporarily. We'll see if it gets extended, but we've had no indication that it's likely to be extended. But if you turn to the next slide, we'll talk about some some recent developments in that regard, which makes something good even better. And that's essentially the introduction in 2018 of what the government called the Accelerated Investment Incentive Property Regime, AIIP. And that's basically a regime that applies to all various classes of depreciable property, but particularly and most generously to renewable energy assets and class 43.2 properties. And basically what the government did is two things which are pretty amazing in this sector. The first thing is they turned off the half-year rule, that rule that says that whatever depreciation you're ordinarily entitled to in year one is decreased by half. So there's no half-year rule. And not only that, but in year one, you have the opposite of a half-year rule. So the rate goes from, well, the rate would normally be 50% for class 43.2 assets. It actually goes to 100%, meaning that you could depreciate 100% of the cost of class 43.2, a renewable property asset, in the first year that it's available for use. So if you bought, you spent $100 million on wind turbines, for example, that's fully write-offable in year one, the year you start, which is an extremely unusual and generous tax incentive, because it creates a large deduction, which we're going to see in a second, can create all kinds of nice tax goodies. This regime is, as I said, temporary. It's only applicable to property that becomes available for use before 2024. So we have 2 more years of it. So it's a nice leadway, but it's important to note that it's not forever. And then the government has set out a gradual phase out. So we don't switch between 2024 and 2027. It's not like in 2024, you go back to the regular 50% rate, 25% in year one, 50 in all the subsequent years. There's a ramp down from 100, and then in 2028, I think, is the first year we're back to the old rules. So we're in an environment where essentially the way the government puts it is you can write off the full cost of renewable energy assets in the year of acquisition as though they were a regular operating expense, which is very unusual. Turn to the next slide. We'll see what that can do. So what it means is that you can basically take this large deduction in the first year, regardless of how much income you make, subject to some rules that we're going to talk about in a second. You may make a very relatively small or modest amount of income in year one, and you have a massive deduction. Essentially, you're deducting the bulk of all the capital expenses, the CapEx related to your project in year one. And what that's going to do in almost all cases, if you choose to take it, is generate a giant tax loss. And a tax loss is extremely valuable because the owner of the project can use that loss to offset income from other sources. And that might be, depending on what business you're in, that might be business income from other sources. If the renewable energy project is just one of the things you're involved in, and the company is actually involved in all kinds of other things at the same time, you have this big loss pool that you can use to offset your other business income. Or if you're only in the renewable energy space, a lot of renewable energy companies, we typically see that they'll sort of create a project and generate losses, and then they'll use each time they create a project, they generate a big loss pool, and they use that loss pool to offset income from the previous project. And then when there's no more losses in the next project, they create another project, generate a big loss pool to offset income from the previous project. So essentially, if you keep building projects, you're in a position to effectively never become taxable because you're constantly creating a large loss pool to offset all the income that you're generating from all your projects. It's very useful, and we call that in tax a tax shelter. Essentially, it's generating a massive tax asset that is very valuable. Just a couple of points that are going to come up also in the rest of the presentation. Obviously, a tax loss is only really important for a taxable investor. So it's only useful to have a tax loss if you're subject to tax in the first place. It might sound obvious, but there's some nuances to that. Tax-exempt investors in Canada, which includes pension funds, municipalities, First Nations, et cetera, they have no use for tax losses directly, because they don't pay tax. Sometimes you'll get a pension fund or a municipality or an Aboriginal group that's involved in a project, and they may say that they want to make sure that the tax incentives are maximized, not because they could ever use them in the project, but because they want to make sure that if they ever sell the project to somebody who's taxable, they want to make sure that they're in a position to be able to sell something to the purchaser that is of value to the purchaser if they're a taxable investor. But generally speaking, it's the taxable entities of this world that really care about all of this accelerated depreciation and this ability to generate the tax shelter. So just a little example, if you turn to the next slide, of what this can do. And what this means is, let's say we've got a 100 megawatt project, a wind project, owned by a taxpayer, and let's say there's $300 million of costs that are eligible for 43.2 treatment, turbines and things like that. And it has income before depreciation of revenue, basically, of $30 million per year. So in the current environment, if let's say your turbines are available for use this year or next year, and therefore they're subject to this new accelerated investment incentive property regime, your income before your CCA, your depreciation, depreciation is called CCA in tax capital cost allowance, is $30 million, and you can claim $300 million, in other words, 100% of the cost of your turbines as a depreciation expense, and you're left with a $270 million loss in year one, and that you can use to shelter other income, be it from other projects or other unrelated income. And so that's really quite unusual and quite amazing. In a normal environment, before the government introduced the accelerated investment incentive property regime, and the environment that we'll go back to eventually in 2028, is not as good, but it's still very good. You can see that in the ordinary environment where the rule is 50% depreciation per year, in the first year you have that half-year rule. So, and 50% of 300 million is 150 million, and because of the half-year rule, you can only take half of that. So you can only take 75 million in year one, and then you're left. That leaves you with a loss of 45 million in the first year, and a remaining undepreciated balance of 225 million at the end of the year. In year two, then you could take 50% of your 225 million. That's 112.5 million, which generates an $82.5 million loss. And you can see that at the end of 5 years, you've basically depreciated all of the cost of your turbines, and after 3 years, you generated a loss pool of $154 million, essentially, which is, again, that's nothing compared to the accelerated investment incentive property regime. It's about half, but this is all very unusual and very generous tax treatment compared to what you ordinarily get if you were in a business that's not the production of renewable energy for what's essentially your CapEx. Generally, that's either not deductible at all, or it's deductible over a very long period of time. So turn to the next slide. The next concept that's often arises in the renewable energy context is what we call PBC status, principal business corporation status. And that's a concept that's been inserted in the Income Tax Act to limit a little bit the ability to generate these large loss pools that we just described. And basically, the rule is that if you're not what we call a PBC, you can only claim depreciation up to the income generated by the project. So in the example we just looked at, where there was $30 million of revenues created per year, you would only be able to take 30 million of depreciation, even though in the current environment, should be entitled to take 300 million. You'd be capped at just the income. You couldn't use the depreciation to create a loss, which is really kind of the name of the game in this business. And so essentially, the rule is that only PBCs are allowed to create a loss, principal business corporations. And what that means is it's a corporation whose principal business is manufacturing or processing, mining, or the sale, distribution, or production of electricity, natural gas, oil, steam, heat, or other energy. And if you're a corporation. And if you're a partnership, it means you're a partnership, all of the members of which meet the definition we just discussed. So what that means is this ability to generate losses is limited to corporations that are in specific industry groups. Essentially, the government wanted only to be able, people only in certain industry groups to be able to use renewable energy projects as a tax shelter. And I should point out that it's only partially effective, that limitation, because the way we typically ensure that the principal business corporation status is met is through a, if you have other businesses, you create a wholly owned subsidiary whose only business is creating the renewable energy project in question. And so it necessarily meets the test. It creates a bunch of losses. And even though we don't have a consolidated income tax system in Canada, if you have a wholly owned subsidiary that's has a bunch of losses, there are ways of, we call them loss utilization transactions, but there are ways of moving the losses around in the corporate group. So it's not completely, the government doesn't love that, but it's not completely effective, this rule that prevents, let's say, people in the financial industry, financial services industry, for example, because they're not in this list of generating losses in this manner. What we often see, and we're going to come to this in the renewable energy space, is that a project will be owned by a partnership. It's very flexible partnerships, and we see them very often, not all the time, but very often in this industry. It's very important for me to stress that looking at the definition, if you're a partnership that owns a renewable energy project, every partner has to be a PBC. So if one partner doesn't qualify, the whole project is ruined for everybody, in the sense that nobody can claim depreciation in excess of income and use losses. So whenever you have a partnership that's carrying on a project, you can expect to see in the subscription agreement all kinds of representations and covenants that make sure that all of the partners at all times meet this test and qualify as a principal business corporation. And that's not necessarily easy to do, because you may often have a situation where you have two corporate groups that want to create a renewable energy project, and we've seen more and more tax exempts investing as being the second group. And for certain tax exempt entities, it's not the easiest thing in the world to create a wholly owned subsidiary that will do nothing else but hold an interest in this energy project to make sure that the partnership qualifies as a principal business corporation. And municipalities in particular often have issues. Sometimes they need special permissions to create wholly owned subsidiaries. But I guess the bottom line is you can't just create a partnership and allow into it whoever you want, even if it's hard for them to create a wholly owned subsidiary that will satisfy these tests. It's not necessarily an easy thing to do. Next slide. And kind of unrelated, but concept that we often see and often get questions about in the renewable energy space is Canadian renewable and conservation expenses, what we call CRCE. CRCE is an interesting little regime, quirky little regime, I would call it, and I'll explain why in a second. But in essence, CRCE, Canadian renewable and conservation expenses, are expenses incurred in connection with the development of a renewable energy project that are typically capital expenses that are non-deductible, and what the CRCE regime does is basically make them fully deductible. And the way that works is it deems them to be, ironically, Canadian exploration expenses, which is a mining concept. So it deems them to be mining expenses, which through a quirk in the income tax system means they fall into this pool that can be deducted at any time in the year they're incurred or later, as opposed to being capital expenses that you have to either amortize over many, many, many years or not deduct at all. And the definition includes basically anything that isn't the cost of a class 43.2 asset, like a turbine, et cetera. And it specifically includes, it's deemed to include expenses for the purpose of making a service connection to a project, for the construction of a temporary access road to the project, for rights of way in respect of a project, to clear land, and most notably, at least in my experience, is process engineering and data collection and analysis. Often what you're doing at the beginning of a project, particularly if you're a developer, is having data collected about the strength of the sun or the wind, for example, in determining whether a site is a good site to build a renewable energy project. And that would ordinarily be a capital expenditure that would be not deductible. And this basically deems it to fall in this special pool that can be deducted at any time. And lastly, you have test wind turbines. The cost of test wind turbines fall into to this pool. So the first thing, again, the first thing to remember about CRCs, it turns something that wouldn't otherwise be deductible into something that is deductible, which is very nice. And it can be deducted either the year you incur it or any year in the future. So that's very nice. And the second, which I've seen not often, but I have seen it a few times, is that CRC expenses can be flowed through in respect of flow-through shares. So some companies will issue flow-through shares to investors, and basically the subscription price of the flow-through shares is used to incur CRCE, and you're deemed as the shareholder of the company to have incurred the CRCE yourself. So you can basically give the CRCE to your investor in a company, which is a very rare thing. You may be familiar with that in the mining context. Again, this regime sort of piggybacks on the mining context, so it allows you to issue flow-through shares, which is kind of neat as well. So I had said that I would provide tips and traps, structuring tips and traps as we go through the various considerations that come up in the context of a renewable energy project. And so I will do that. The first trap that I've encountered in my career is that a property, the cost of which was CRCE, like wind data, for example, if you sell it, does not give rise to a capital gain. The proceeds of disposition of property, the cost of which was CRCE, is essentially treated as ordinary income. And you probably know, most of you, that capital gains are taxed at a much more favorable rate than ordinary income. In Canada, the capital gains rate is about 12.5 to 15% for corporations, and it's 25 to 30% for ordinary income. So makes a big difference if you're selling CRCE or not CRCE. And you might think, oh, it sort of is what it is, but usually when you're selling a bunch of assets, for example, if you've developed a project and you're about to sell it, before it actually comes online, to somebody who wants to take over your kind of rights under an RFP or a request for proposals that you've succeeded in winning. You'll be selling them a whole bunch of assets, and some are CRCE and some are not. And then you'll go to determine what the purchase price allocation should be. And it makes all the difference whether you allocate the purchase price, a lot of the purchase price or a little amount of the purchase price, to things like wind data. And the purchaser is going to come to you and say, let's treat it all as the whole purchase price is allocable to your wind data, because that's interesting to the purchaser, because then they'll be able to treat it as CRCE. They'll say that's the cost of getting wind data, and that's what CRCE is. And so they'll be very interested in getting in allocating all of the purchase price to that. But the vendor has the opposite incentive. The vendor is going to want to allocate most of the purchase price to other assets that are not CRCE, because whatever is allocated to CRCE will be treated as ordinary income. So something that often gets ignored, including by some tax people, is the purchase price allocation. And it's very sensitive in this context, because it can make a very big difference in your after-tax profit. because of what we're discussing. The second trap is that CRCE, one of the limitations on CRCE is it only includes an expense that's incurred by paying an amount to a person with whom the taxpayer deals at arm's length. So you can't treat as CRCE an amount paid to a related member of the group, for example. And where this comes up is some developers that we've represented in the past will, for example, have one entity in their group that does all their development. And then once they're ready to create a project, to bid on a project, they'll transfer all of their assets relating to the project to a new entity, a new partnership, a new entity in the group that's actually going to bid on the project. And it's very important when you do that to be careful, because if the new entity that's going to bid and that's buying the assets pays for wind data, for example, in the case of a wind project, it is acquiring what would otherwise be CRC, but because it's acquiring it from a related person in the group, the amount doesn't qualify as CRCE. So basically what you've done in that situation is you've taken something that should be CRCE and would have been CRCE to the vendor, and the new entity that you created is buying it and basically is disqualified from treating it as CRCE. So you can kind of lose your CRC status by moving things around in a corporate group. And sometimes we address that by, again, through the purchase price allocation and how much we treat something as how much value we allocate to a property that the cost of which is CRC. But that's another kind of trap, is moving things around in the group can cause you to lose something that would otherwise be valuable. So going right into the nub of it, if you will, is tax structuring of renewable energy projects, and the kind of three, broadly speaking, structures that we typically see. And I apologize, this is going to get very taxy, but hopefully it won't be too technical or too uninteresting for the non-tax people in the audience. But basically, there are two categories of structures: corporate structures. You have investors in a corporation that holds your project. And then there are flow-through structures, and there's two kinds of flow-through structures. You basically have partnership structures, where you have investors in a partnership that holds the project assets, and you have joint venture structures, where you have a group of investors that basically co-own the project assets. There's no entity between them. They just co-own the assets in a joint venture, unincorporated joint venture. So we're going to talk a little bit about why you might pick some of these rather than others. So you can change the slide. So beginning with corporate structures, which is typically what we see outside the renewable energy context, and very rarely what we see in the renewable energy context. I'll explain why in a second. Corporations are, the key is that corporations are taxed separately from their shareholders. They're deemed to be their own person for tax purposes, the same way they are for legal purposes. And that's generally bad in this space for taxable investors, because if you're a taxable investor, an ordinary investor who pays tax in a project, and you want the project to generate tax losses by taking this accelerated depreciation, all of those losses are trapped in the corporation. And unless you do something to move them from the corporation to you, they're stuck there. So I say it may be possible to remedy this using loss utilization transactions, but that's easier said than done, and can be expensive and is not always possible. So a taxable investor doesn't love a corporate structure, because all the tax goodies are stuck not in the taxpayer. And tax exempt investors also don't like corporations, so it's really good for no one, and that's why we typically don't have them in this context, because they suffer what we call leakage in the form of the tax payable at the corporate level. If a tax exempt investor owned an energy project, themselves, and made money on it, made income on it, they would not pay any tax on it. But if they're carrying on the project through a corporation, the corporation is not a tax exempt, and so the corporation pays tax. So if you an example of that is if you look at the second half of the screen in the bottom, you have if you have a project that's a corporate project, and the project throws off $30 million of income, it has $30 million in theory of cash that it could distribute, but it has to pay tax on the $30 million of cash. So it pays $8 million of tax, which is, assuming it's in Ontario or Quebec, it's a 26.5% tax rate. That means that the tax exempt gets $4 million less than it would if it was not investing through a taxable vehicle. It's getting $11 million in this example instead of half of 30, which would be 15. And then another advantage of the only advantage essentially of corporate structures is they're the cleanest to sell. When you sell a corporate structure, it's pretty clear that 100% of the time, almost 100% of the time, you're going to realize a capital gain on your exit, and that's taxable in the hands of the shareholder, and you pay tax at that low rate that we discussed. So that's the main benefit. You're going to see when we talk about partnership structures and joint venture structures that it's that you can have some exit issues and on the tax rate, getting that low tax rate in those other structures. I realize I just the illustration. There's an illustration there of the tax losses being trapped. In case you didn't follow that, so on the left you see for a taxable. The reason taxables don't like corporate structures is you see if the corporation, in this case that owns the project, has a tax loss of $50 million, in theory the taxable investor should be entitled to half of that, 25 million, sorry, not $25, but it can't because that tax loss is trapped in the corporation. Okay, move on to the next slide. So the next type of structure, which I would say is the most common, though we do see joint venture structures, is partnership structures. Partnerships, just the important thing to bear in mind, and that explains a lot of the reason we see them here, is that partnerships are what we call flow-through or transparent in Canada. And that means they don't pay tax. They compute their income or their losses, and then they allocate those income and losses to the partners. And the partners then include the income or the loss on their own tax return. And that's very well suited to tax exempts, because that means no tax is paid at the project level. So again, going back to our example that we just looked at, if the project generates a $50 million, if the project generates $30 million of income, half of that income is allocated to the tax exempt. You can pay $15 million to the tax exempt, and then the tax exempt is responsible for paying tax on it. And the tax payable is zero because the tax exempt doesn't pay any tax. So that's very nice for a tax exempt. And it's also good for the taxable investor because, again, the taxable investor, if the project has a loss, the loss is not trapped in the partnership. It's allocated to 50-50 to the two investors in our example, which means that the taxable investor has access to its share of the loss. It's not trapped in the project. Something to note, which has received increasing amounts of attention in the last few years, is that the Income Tax Act in Canada leaves a lot of flexibility as to how you allocate income and losses, how you decide who has to include what on their tax return. There's a lot of flexibility, or there's more flexibility in Canada than in some other jurisdictions like the United States. And essentially, the only restriction is that the allocation has to be "quote unquote" reasonable, and there has to be essentially an economic justification for what you're doing. But that leaves quite a bit of wiggle room for the parties in determining what that economic justification is, and that can create tax planning opportunities. Because if you have a mix of taxable and tax exempt investors, which we're seeing more and more as RFPs in recent years have required actually that you include tax exempt investors in some cases in the project, like First Nations and municipalities. That creates tax planning opportunities because it's apart from where the money is going. Obviously, if you're a partner with a tax exempt and you're taxable, you'd rather have the maximum amount of tax income allocated to your partner. Again, it has nothing to do with how much cash you get. But you want all the income to be allocated to your partner and all the losses allocated to you, because your partner doesn't pay any tax and so doesn't care about having income allocated to them. and your partner doesn't pay any tax, and so doesn't care about getting access to their share of the losses. And so there are basically some techniques that have arisen that we've developed for skewing basically the picture so that the maximum amount of loss goes to the taxable, and the maximum amount of and the least amount of income goes to the taxable. And that there's a few techniques for doing this, but one of them is through having the tax-exempt investor invest by way of debt. And the idea there is if the tax-exempt investor invests in the project by way of debt, the taxable has contributed 100% of the equity, and so the theory goes it should therefore be allocated 100% of the losses generated by the project. And or in some cases, especially when the RFP is requiring the presence of a tax exempt, the taxable investors are supplying all the capital. And where that's the case, we sometimes have them subscribe for preferred units. And then we have the taxable and the non-taxable subscribe for common units for a nominal amount. And then again, the idea is the taxable has contributed almost all of the equity, and so it's allocated almost all the losses. It's important to model these out carefully because typically there's I think the term that's often used is a whipsaw. Typically, by causing all of the tax aspects to be allocated one way, typically there's a moment where there's no more losses, and then your interests become the opposite. So if you created a project whereby you want all of the losses to be allocated to you, and there's no more losses, it also usually means that all of the income is going to be allocated to you. And if you're taxable, that's the opposite of what you want. So some of the art here is causing things to flip over. Once there are no more losses, you ideally want to revert to a structure where things are spread 50-50. So that leads to a lot of neat tax planning. So just an illustration of what we just discussed in a situation where a partnership, where a project has a loss. Again, if it's a $50 million loss, in theory, 50-50 partners, 25%, 50%, and therefore $25 million of the loss belongs to the tax exempt and 25 belongs to the taxable. Again, that's good. That means the taxable can make use of the loss. Remember, in the corporate structure, that $25 million of loss was stuck in the corporation. And in a situation where the partnership has income, the tax exempt is happy because the $30 million of income in this example, $15 million of it belongs to the tax exempt. You give the tax exempt the $15 million, and then the tax exempt is supposed to pay tax on it on their own. And of course, the tax exempt doesn't pay tax on it because it doesn't pay any tax. So it gets its full $15 million instead of an after-tax return, which would be the case in the corporation. The corporation would pay tax on the $15 million belonging to the exempt investor and give it what's left after paying the tax, which was around $11 million in our example. So much better for everybody, the partnership structure. And it's part of the reason why it's one of the most typical that we see where you have more than one investor. Next slide. Some things to bear in mind, which are some annoyances associated with partnerships. There are complicated rules in the Income Tax Act for partnerships. They're a bit annoying. One is the at-risk rules, and that basically limits the amount of losses you can take out of a partnership, which is a big deal in an environment where creating losses with accelerated depreciation is the name of the game. Basically, you're limited to you can only take losses out of a partnership up to what we call your at-risk amount, which is generally speaking the tax cost of your units of the partnership. And the other thing that sometimes trips us up is what's called the negative ACB rule. ACB is tax cost. It's the adjusted cost base. It's a fancy word for tax cost. And when your cost goes negative, you're deemed to have a capital gain if you're a limited partner of a limited partnership. And typically, by the way, both of these rules only apply to limited partnerships, but we typically only see limited partnerships because it's very rare that investors want to invest in an entity that's a general partnership and have unlimited liability. So what does it mean for your tax costs to go negative? Essentially, when you take a distribution out of a partnership, it's deducted from your tax cost. So at some point, if your distributions exceed your tax cost, your tax cost goes negative, and the negative amount is deemed to be a capital gain. So that can be annoying too. And these are things you don't have to worry about with corporate and joint venture structures. A trap, which again has led to lots of fees for a lot of tax lawyers and accountants, is the disposition of partnership interest to a tax exempt or a non-resident. A few years ago, it was always the case for a tax exempt, and now the government added about 10 years ago non-residents to the list. One disadvantage of using a partnership is if you sell a partnership interest that derives most of its value from depreciable property, which is almost every renewable energy project. The gain that's realized on the sale of your units is taxable as ordinary income if the purchaser is a tax-exempt person or a non-resident person, or a partnership with tax-exempt or non-resident persons, and certain trusts with tax-exempt persons or non-resident persons, which either restricts the amount, the universe of people that you can transact with, or creates issues if you have two partners. One is tax-exempt and one is not tax-exempt, and you might have in your partnership agreement all kinds of puts and calls, all kinds of situations where one partner is selling units to the other partner if certain things occur. And it may be that you're forcing yourself to sell to a tax-exempt or a non-resident, and therefore are going to pay much more tax than you should. And it's important to bear that in mind when you're negotiating these clauses. And again, this is increasingly relevant as we see more and more tax-exempts in this space. There's quite a lot of ways to there are several ways, I should say, to structure around this rule that involves the sale of a partnership interest, and obviously, if you're dealing with those issues, you can talk about them with your tax lawyer or tax accountant. But it's important to provide for them and bear them in mind rather than just walking into this and paying a penal amount of tax. So this slide is another neat aspect of partnerships, which doesn't relate to some of the other things we talked about. A partnership is a useful tool in the renewable energy context when you have a project and you want to sell only a part of it to an investor. So take the example that we've got here, where you've got project assets that have a cost of 50 and a fair market value of 80. And if you wanted to sell 50% of them to a co-investor, if you just sold 50% of the assets to the co-investor, you would realize a capital gain, because if you sold 50% of the assets would have 50% of your cost, 25 million. And if you sold them for 50% of their fair market value, which is 40 million, you would have a $15 million capital gain. You'd have proceeds of 80 and a cost of 25. So you'd have a $15 million capital gain. And what you can do with a partnership is you can dispose of you can transfer the assets to the partnership in exchange for a $40 million promissory note. And then have the investor invest $40 million in the partnership, which is used to repay your promissory note. And then you end up with the investor holding 50% of the units that he bought for $40 million, and you own 50% of the units. And the way the Income Tax Act works, you're allowed to basically take the $40 million and apply it against your cost of 50, instead of having your cost prorated and only being able to use half of it because you sold half of the asset. You can use the first $40 million of your cost. So you end up with $10 million of cost here, but you pay no tax on that transaction, and that requires a rollover. It's the way our rollover provisions work in the Income Tax Act. So turning a project that's held directly into a partnership, as opposed to a joint venture, for example, is a way of using a partnership to avoid paying tax on a transaction like that. You could pay zero, in fact, in this example. The last topic we'll be covering is joint venture structures, which are similar to partnerships but not identical. And they are, to some extent, there are some, we sometimes see them because they do have some advantages, but they also have some disadvantages that result in still the majority of our projects that we see being partnerships. A joint venture is not a legal entity. It's really essentially just a co-ownership. The two investors co-own the project, and each member is considered to own an undivided interest in the project assets and earn its share of an undivided interest in the joint venture's revenues, which means as a result, you have the two big advantages of partnerships. Losses basically belong 50-50 in a case of a 50-50 joint venture to the joint venturers. They're not trapped in the project. And no tax is paid at the joint venture level. Basically, just 50% of the income belongs to one party and 50% belongs to the other. And if the other party is tax exempt, they just pay no tax on their share of the income. So that's very nice. Another advantage of the JV structure is technically you each own your pro rata share of the project assets, which means you get to decide how much depreciation you want, and the other party has to decide. Because depreciation, I'm not sure I mentioned that, but it's discretionary. You can take none of it, or you can take all of it. So when we say that you can depreciate 100% of the cost of a class 43.2 renewable energy asset until 2024, you could also choose not to take it if you don't need the tax shelter, for example. So to avoid having to discuss with your other partner and come to some kind of agreement over how you're going to decide each year how much depreciation to take, a joint venture is a nice way of allowing each party to make its own decision. Because the partnership, if you were in a partnership structure or a corporate structure, it's the partnership or the corporation that decides how much depreciation is taken. So you have to come to a collective decision. The main disadvantage of a joint venture structure is the absence of limited liability. If you invest in a corporation or a limited partnership, you have limited liability. If you're invested directly in a joint venture, you don't, which means you have to essentially create a limited liability entity to hold your interest, and then you're just spitting yourself back into the corporate structure and or the partnership structure, depending on which limited liability vehicle you use, which SPV you use. And the last disadvantage, which is as we said, something you don't have in the corporate world and you only sometimes have in the partnership world, is when you sell a joint venture, you're actually selling the underlying assets, and you can realize a capital gain, but you can also realize what we call recaptured depreciation, which is often significant in this context. And recapture is, again, it's taxed at the full ordinary corporate rate of 25 to 30%, rather than the capital gains rate of 12.5 to 15%. So that's another reason why we see joint venture structures a little bit less. And on the last slide, you see that just illustrating this again, a bit like in a partnership context, where if you have tax losses, for example, that you take through depreciation, the losses basically get allocated 50-50 to the taxable to the investor, and so so they can each use them. They're not trapped in the corporation. And you could see that, as I said before, one taxable investor might need $40 million of depreciation because they have other income, and one taxable investor might only need $16 million of depreciation. So one can take 16, one can take 40. We don't have to agree on how much depreciation we're all going to take. Everyone takes what they need. And in the income scenario, again, for tax exempts, that's very interesting, as they don't want an after-tax return. If you've got $30 million of income, 15 of it belongs to the tax exempt, and they pay tax on it at zero, because tax exempts don't pay income tax. So so it works for them as well. So we sometimes see these joint venture structures, but more typically partnership structures. I've included an appendix, which I won't go through, obviously, but it provides a little neat summary of some of the pros and cons of the structures that you're looking at. If you can sort of use that as a tool to help you decide which way you're going to go in a given case. Again, a partnership is definitely the most common. So that really completes the presentation. I'm happy to take questions. We've got if a tax-exempt partner sells its partnership interest to a taxable purchaser, can the purchaser use or benefit from the accrued tax losses that were not usable by the vendor, or the purchaser can only begin to benefit from the tax losses earned as of the date of purchase? It kind of depends. So that's a good question. It kind of depends on the structure of your deal, but the short answer is yes. The short answer is that if you buy a project, you can use the tax losses. I would say directly or indirectly. A partnership, again, doesn't have losses per se. So let's say you were buying units of a partnership. What you would inherit is whatever unused depreciation is in the partnership. So if there's, let's say you paid $300 million for turbines and or solar panels or whatever it is, and that's you have costs of $300 million in the partnership. If you buy the units, whatever depreciation is left in there, you can take as the new owner of the partnership units. The problem in this context is usually people take a ton at the beginning to generate losses, and it may be that when you buy the partnership units, there's nothing left. And so sometimes what we see is a negotiation of the purchase price to reflect the fact that if you're buying partnership units, you'll say, well, I'd really like to buy the assets because I'd like to refresh the cost of the assets, and so I could start taking depreciation on a fresh $300 million. Let's say you paid $300 million for your turbines and you depreciated all of it, and you want to sell it to someone for $300 million. They'll say, oh, I would have liked to have a $300 million pool of my own. There's nothing left in there. And sometimes that will affect the purchase price or transform the form of the deal. But in a nutshell, the answer to that question is yes. I think I have another question. No. Not sure if there's any other questions. Okay, well, it's been a pleasure to talk about tax with you. I hope you found it interesting and helpful. Just a reminder to fill in our survey if you haven't done so. And then the next webinar is Fasken's quarterly perspective on tax law topic, mergers and acquisitions and private equity tax developments, and that'll be on September 21st. Please keep an eye on your inbox or visit the Fasken Institute section of fasken.com to register for that or any of our events. And if you missed our last webinar, Digital Taxes and the OECD G20 Inclusive Framework on International Taxation, you can access that also at our website, fasken.com. We've got a recording of that as well. So have a good afternoon.